Let's look at the differences between credits and deductions. A tax credit reduces your tax liability on a dollar-for-dollar basis, and so is generally more valuable than a deduction, which reduces your taxable income. For example, let's say you're in the 25% tax bracket and you have a choice between a $100 deduction or a $100 credit. If you claim the $100 deduction, your income goes down by $100 and your tax goes down by $25. However, if you claim the $100 credit, your tax goes down by $100. Non-refundable credits appear on lines 48 through 55 of the Form 1040. Non-refundable means that these credits simply go to offset your taxes. First, we'll talk about the foreign tax credit. The foreign tax credit on Form 1040, line 48, is intended to reduce the double tax burden that arises when foreign source income is taxed by both the United States and the foreign country from which the income is derived. To qualify for the foreign tax credit, a taxpayer must have earned income in a foreign country, have paid taxes on that income to the foreign country, and not have claimed the foreign earned income exclusion on the same income. Foreign taxes that generally qualify for the foreign tax credit include taxes on wages, dividends, interest, royalties, annuities. If a taxpayer receives a foreign tax on income, he or she has a choice. Claim the foreign tax as an itemized deduction, which we saw earlier, or claim a foreign tax credit. The itemized deduction is quick and easy, but it provides a small benefit and in some cases can provide no benefit at all. The tax credit usually provides a larger benefit, but can sometimes be difficult to calculate. The main reason some people claim the deduction instead of the credit is that it's necessary to fill out a complicated form, Form 1116, in order to claim the foreign tax credit. Not only is this form complicated, but the taxpayer has to track down information and perform calculations that aren't shown on the form. Beginning in 1998, however, the IRS adopted a procedure where a taxpayer can claim the foreign tax credit without having to file Form 1116 if the total foreign taxes are $300 or less for a single person, $600 or less on a joint return, and certain other requirements are met. That's a big help for many taxpayers because the tax benefit on small amounts was often too great to justify the hassle that's involved in filling out Form 1116. In summary, taxpayers who pay taxes to a foreign country may be able to take a non-refundable foreign tax credit. Generally, Form 1116 is required to claim the foreign tax credit. Certain taxpayers may be able to claim foreign tax credits without Form 1116. And to qualify for the foreign tax credit, the taxpayer, income, and taxes must all meet specific requirements. If the taxpayer uses the foreign earned income exclusion, foreign tax paid on the excluded income cannot be used to claim the foreign tax credit. The credit for child and dependent care expenses is calculated on Form 2441 and ends up on line 49 of the Form 1040. Individuals who pay for daycare expenses for their children or disabled adult dependents may be eligible for a federal tax credit of up to 35% of the cost of the daycare. Child and dependent care credit is what's known as a non-refundable credit, meaning that the credit is applied against tax. To qualify for the child and dependent care credit, The taxpayer must have a dependent child age 12 or younger, or a dependent of any age who cannot care for himself or herself. And again, the credit is calculated on Form 2441. In order to claim this tax credit, each of the following criteria must be met. The child or dependent must meet certain qualifications. The daycare provider must meet certain qualifications. The taxpayer must have earned income. The care provided must enable the taxpayer to work or to look for work. And the taxpayer must reduce daycare expenses by any amounts that are provided by the employer. Generally, the filing status on the return cannot be married filing separate. The more than half rules involve the following. If your filing status is married filing separately and you lived apart from your spouse during the last 6 months of the year, and your home is the qualifying person's main home for more than half the year, and you paid more than half the cost of keeping up the home for the year, then you're considered unmarried for purposes of claiming the credit on Form 2441. The qualifying child or dependent rules involve the following. The child must be a dependent, age 12 or younger, and if your child is age 13 or older, the child must be physically or mentally unable to care for herself or himself. Adult daycare expenses may also be claimed for a dependent age 13 or older or for a spouse, if that person is physically or mentally unable to care for himself or herself. A home must be provided for the dependent, and over half the costs of maintaining the home must be provided for the dependent. Child care or adult daycare expenses can't be claimed for someone who does not live with the taxpayer. The person who provides the child care or adult daycare services cannot be a dependent. For example, a taxpayer cannot pay his daughter to take care of her younger brother. If the daycare provider is a son or daughter, then he or she must not be a dependent and must be age 19 or older by the end of the tax year. Also, the daycare provider must provide his or her name, business name, address, and either Social Security or employer identification number. How much is the Child Independent Care credit worth? Well, the Child Independent Care tax credit can be worth 20 to 35% of the total daycare expenses paid. The percentage of the credit depends on adjusted gross income. The maximum amount of expenses that can be claimed on a 2016 tax return for the Child Independent Care credit is $3,000 for one qualifying dependent, $6,000 for two or more qualifying dependents. And again, this is not the amount of the credit. These are the maximum amount of expenses that can be claimed. The credit is on a sliding scale depending on adjusted gross income. In summary, the Child Independent Care credit is a non-refundable credit that allows taxpayers to reduce their tax liability by a percentage of their child independent care expenses. Maximum expense amounts are $3,000 for one qualifying person and $6,000 for two or more qualifying persons. The credit rate is 20 to 35% of the taxpayer's expenses. Generally, married couples must file a joint return. The credit is calculated and reported on Form 2441. The taxpayer's child independent care expenses are subject to an earned income limit. Next, we'll move on to education credits. These are calculated on Form 8863. They flow to line 50 on the Form 1040. There are two tax credits for higher education. The American Opportunity Credit provides a refundable tax credit of up to $2,500 for undergraduate education. The American Opportunity Credit was scheduled to expire at the end of 2012. However, it was extended through December of 2017 by the American Taxpayer Relief Act of 2012. Details of the American Opportunity Credit involve availability for the first 4 years of college per eligible student. The credit covers 100% of the first $2,000 and 25% of the second $2,000 of eligible expenses up to the amount of tax or a maximum of $2,500. 40% of this credit is a refundable credit. Who can claim the American Opportunity Tax Credit? Well, generally, you can claim the American Opportunity Tax Credit if all three of the following requirements are met. You pay qualified tuition and related expenses of higher education. You pay the tuition and related expenses for an eligible student. The eligible student is either yourself, your spouse, or a dependent for whom you claim an exemption on your tax return. You cannot claim the American Opportunity Tax Credit if any of the following apply. The filing status is married filing separately. Listed as a dependent in the exemption section on another person's tax return, such as your parents' return. Your modified adjusted gross income for 2016 is $90,000 or more, $180,000 or more in the case of a joint return. Form 1098-T reports tuition and expenses. Box 5 shows financial aid and scholarships made to the student during the tax year. If the student's aid exceeds tuition and fees, then the tax credit may not be taken. We subtract Box 5 from Box 1 or Box 2. Box 8 tells the student if he or she qualifies for the American Opportunity Credit. The law states that a student must be enrolled at least half-time in a degree or certificate program. If the student qualifies, then the box will be marked with an X. The second higher education credit is called the Lifetime Learning Credit. The Lifetime Learning Credit provides a tax credit of up to $2,000 for any level of college education, even graduate school, and does not require a minimum level of enrollment. The Lifetime Learning Credit is also a non-refundable tax credit up to $2,000 per family for all undergraduate and graduate level education. It's calculated by taking 20% of the first $10,000 of qualified educational expenses paid. Who's eligible for the Lifetime Learning Credit? Generally, you can claim the Lifetime Learning Credit if all three of the following requirements are met. First, you pay qualified tuition and related expenses of higher education. Second, you pay the tuition and related expenses for an eligible student. Third, the eligible student is either yourself, your spouse, or a dependent for who you claim an exemption on your tax return. You cannot claim the Lifetime Learning Credit if any of the following apply. Your filing status, again, married filing separately. You're listed as a dependent in the exemption section on another person's tax return, such as your parents' return. Your modified adjusted gross income in 2016 is $64,000 or more, $128,000 or more in the case of a joint return. You can't claim the Lifetime Learning Credit if you claim the American Opportunity Credit for the same student in the same tax year. What types of expenses qualify for these education credits? Expenses that qualify are tuition and fees that are required for enrollment or attendance at any accredited college, vocational school, or other post-secondary educational institution that's eligible to participate in the student aid programs administered by the Department of Education. A searchable database of all accredited schools is available at the following web address. What types of expenses don't qualify for the education credits? Well, qualified expenses do not include room and board, oddly enough, student activities, transportation, or other similar personal, living, or family expenses. Can I claim an education credit if I'm married but file separately? No. Neither the American Opportunity Credit nor the Lifetime Learning Credit can be claimed if the individual is married but filing a separate return. If the amount of qualified tuition and fees that I pay is greater than the amount of a scholarship, should I fill out the Form 8863? Absolutely, but you must reduce the qualified expenses by the amount of any tax-free educational assistance. Do not reduce the qualified expenses by amount paid with the student's earnings, loans, gifts, inheritances, and personal savings. If tuition was paid by a government-subsidized loan, can I still take the American Opportunity or the Lifetime Learning Credit? If you take out a loan to pay higher education expenses, then those expenses may qualify for the credit if you will be required to pay back the loan. The credit is claimed in the year in which the expenses are paid, not in the year in which the loan is repaid. Let's look at a comparison chart of these education credits. On the left side, we have the American Opportunity Credit. On the right, the Lifetime Learning Credit. The American Opportunity Credit, we get a max of $2,500 credit per student, 100% of the first $2,000, 25% of the remaining expenses. The Lifetime Learning Credit, we get a max of $2,000 credit per return. The American Opportunity side, the income limit is $180,000 if married, $90,000 if single, head of household, or qualifying widow or widower. The income limit on the Lifetime Learning Credit, $128,000 if married, $64,000 if single, head of household, or qualifying widow or widower. 40% of the American Opportunity Credit may be refundable. The Lifetime Learning Credit is a non-refundable credit. It's limited to calculated tax on the return. The American Opportunity Credit is available for the first 4 years of college only. The Lifetime Learning Credit is available for all years of college and for job improvement courses. The student must be pursuing a degree to qualify for the American Opportunity Credit. Degree pursuit is not necessary for the Lifetime Learning Credit. The student must be enrolled at least half-time for the American Opportunity Credit. The Lifetime Learning Credit is available for one or more courses. The American Opportunity Credit, to qualify, you can have no felony drug convictions. Felony drug convictions will be permitted to qualify for the Lifetime Learning Credit. In summary, 2 education credits may reduce a taxpayer's tax liability: the American Opportunity Credit, the Lifetime Learning Credit. The American Opportunity Tax Credit is worth up to $2,500 on the first $4,000 of qualifying educational expenses, which include course materials as well as tuition. If the student or the parents are married filing separate, then the American Opportunity Credit and the Lifetime Learning Credit cannot be taken. Taxpayers cannot receive multiple benefits for the same student's expenses. Now let's take on some review questions.